Ryan Morrissey. I've known Ryan for a while now. I had the great pleasure. We talk about wealth management, about what you're doing with your money, and just the difference between a financial advisor and wealth manager or a wealth advisor. There's so many kind of bad actors in this space, and we hear about Ponzi schemes and corruption and technology. And, who do we trust? What questions do we need to ask to find someone or a team that can help us with our retirement, with managing our money? It's really a trust thing because you have to trust the person, you have to trust the organization. We talk very much about that. We also talk about some predictions he has for 2023 in finances. He gives 6 predictions. We go through each one. He's got a great podcast where he talks about questions you need to ask a financial advisor or a wealth manager. Are they a broker? Are they a fiduciary? What do these terms mean? Are they fee based? Really important to understand the differences there. He has got great podcasts on credit, what to do with that, with the Secure Act the Secure Act 2.0 that Congress passed at the end of 2022. We talk a lot about that, cryptocurrency, and how to diversify, and just a great conversation. Very interesting. It's a very personal and deep subject, your money and what to do with it. And Ryan gives great insight and perspective. Thanks for listening.
Hi, I'm Joey Pinz. People ask me, how did I lose 130 pounds? The quick answer is always discipline. I started my business, wasn't paying attention to my health, was eating too much, drinking too much sweets. My daughter was born. Next thing I know, I'm pre-diabetic, I have hypertension. I knew something had to change. Discipline. I, like many of you, have faced many challenges in your career, in your family, in your life, in your faith. How did you attack them? How did you approach them? How did you solve them, hopefully? It all had to have some degree of discipline. I'm also asked, how did you found and start a tech business that lasted over 25 years? Discipline. I was committed to it, enjoyed technology, didn't enjoy some aspects of it, but knew it was necessary. Discipline. Our podcast mission, how do we use discipline to better ourselves and society? Join me, please, as I talk to interesting people and discuss how they use discipline in their family and their passion and their careers and how it helped them. Our podcast vision, growth through learning from others. Joey Pinz Discipline Conversations. It'll be light and serious. Join us, please. Thank you for consideration.
Ryan Morrissey, thank you so much for your time today. I really appreciate it. I know we had to bump the schedule a little bit, but it worked out. We're finally talking. What's the difference between a wealth manager and financial advisor and a wealth manager?
So it really depends on, first of all, thanks for having me on the show. It really depends what they do. Sometimes a financial advisor just deals with investments and a wealth manager does investing and financial planning. But there are some people that do call themselves a financial advisor that do both. So there are just a lot of designations and titles out there that can be confusing for sure.
Yeah, that's why I asked, because I don't. And which are you?
So I would be a wealth advisor because I help people with investing and also financial planning. So that's why I use that title, and that's years ago when I started using that. But some people use that, and I don't think really do a lot of financial planning. But yeah,
go ahead.
Yeah, please. The big thing is, so I'm what's known as a fee-only financial planner, and that means that I don't receive any commissions from any products or investments that I recommend to my clients. My clients only compensate me through the fees that they pay me. And that, I think, is really the biggest thing that someone should look for, because that also means that I'm a fiduciary, which means that I'm always putting my clients' interest ahead of my own. And if I have any conflicts of interest, I disclose them. And not
that's the term we
hear. Yeah, that's the big one. Yeah.
Fiduciary. Yeah, that's what I hear. Yeah.
Fiduciary, and also fee only, because to further confuse There's some people that are fee based, which means they sometimes work as a fiduciary, but sometimes work as a broker. And you don't really know like what hat they're wearing. Like when they make a recommendation, is it because they're being a fiduciary or because they're being a broker and they, want to generate a high commission possibly?
The bad actors in the field have caused so much kind of confusion, and we as the public don't know kind of who to trust and who to talk to, and how do we find a good one? How do we know when they're good? What are the right questions to ask?
Well, it's funny you asked that. I have a blog post titled "The 10 Interview Questions to Ask a Financial Advisor," and I send that to every prospective client, so they not only know what my answers are to those questions, but if they want to take that and go interview multiple advisors, it can be very helpful. And definitely one of those questions is, "Are you a fee-only financial advisor?" Because that just helps minimize as many conflicts as possible. And also, I tell people they should do some research on their potential advisor. And there's a couple ways to do that. One website is called Broker Check, and it's actually FINRA, which is the Financial Regulatory Authority. They maintain this website. So right away, you can put someone's name in there. If they're registered as a broker, you can find out what licenses they have, what their experience has been, and most importantly, any complaints that they have.
Hmm.
So if you see someone with a history of complaints, maybe that's not the advisor that you want to consider working with.
And you mentioned licensing. How does that work?
Great question. So, the to be a broker, there's one license called a Series 7 or a Series 6, and the Series 7 is more comprehensive, allows you to trade stocks, where the Series 6 is really just mutual funds. And then a fee only financial planner is going to be, or fee only financial advisor is going to have a Series 65. And so that's I used to have both the Series 7 and Series 65, but a number of years ago I made the decision to be a fee only financial advisor, so I let my Series 7 lapse. So I just maintained my Series 65.
Does Regardless of salary and income, should everybody have a financial advisor? Have someone like yourself?
I think yes, most people probably should, or at least at certain points in life, like transition points, it can be very helpful. So I offer two ways I help clients. One is just standalone financial planning. And that is where a client can engage me. Like I focus really on people getting close to retirement. They want to figure out when can they retire? Do they have enough money saved? What things should they be doing to prepare for retirement?
Hmm.
And they can just engage me for 1 year. That's the agreements that I offer. And then if they feel comfortable after that going on their own, they can go on their own. But at least I've really helped them avoid, the major pitfalls that, they should be avoiding. And then the other I offer is like for people that want ongoing advice beyond that is that they can either renew that agreement annually or we can manage their portfolio if it makes sense. And as part of that portfolio management service, we also offer ongoing financial planning.
And do you team with one of the large institutions that does all the brokering? Do you diversify that? How does that work?
No, that's a great question. So I use Charles Schwab and TD Ameritrade. Those are the two brokers that I use. I use a few other small ones, but so that's, if client is, I'm helping them manage their investments, the first thing we'll do is help them open an account at one of those two places. And then part of what they're doing is giving my firm authorization to be able to manage that account.
Mm.
But the reason I think that's really important is that I have a podcast also titled like "How to Not Get Ripped Off by Your Financial Advisor," and I talk about how Bernie Madoff committed his fraud. This is well known now, but he actually held his clients' money. So
Wow.
he was like, generating these fake statements that said people had X amount of dollars, but nobody was double checking that. And that's why I use a third party, Charles Schwab and TD Ameritrade. They're the ones that do all the numbers as far as reporting to clients how much money they have, the transactions that have occurred, so that, if I'm trying to do anything funny, they're going to know about that right away.
I just watched that Bernie Madoff documentary, and it's amazing to me that well, without the recession, he would have probably still be going now.
I know, pretty scary, right? Yeah.
I mean, so he was just these Ponzi schemes work until everybody asks for their money.
Or at least enough of the people do, right? But
Right, at
then
least enough.
outflows exceed the inflows. And then there's trouble. And these are
Uh,
always happening. I mean, you read in the paper, it seems like every at least once a quarter, twice a year, you're reading about a new Ponzi scheme that was unearthed. And they're not as big as that one, but if somebody steals $100 million of people's money, that really hurts for those people. And a lot of times they don't get it back.
yeah, and we're learning recently that some Indian firm was just released that they're, I forget the name, I forget the details, but you're right. We're just hearing it more and more.
Yeah, I saw that too. I just briefly saw that story that it's same thing. Like people, I think some independent party reviewed their financial statements and said like, they don't really have what they said they have or something like that.
But Madoff had another floor on his building where his some of his family were there, and they couldn't talk to the other floor, and they were regulating, and he was paying people off, and he would. It's just absolutely incredible the lengths that he went through, and um, the recorded conversations from the federal government and how they backed off at certain points and came back on, and so it's just this kind of distrust of the industry, Ryan. And, we need more people like yourself that there's clear and evident checks and balances that are there to make everything equal.
Yeah, and I think to make it a true profession, it would be like everybody is clearly distinguished between being a fee only financial advisor and being a
Mm.
broker. There are certain instances where if you don't need advice, if you just need to put a transaction in, like trade a stock or buy a mutual fund, that's okay to deal with a broker. Charles Schwab, Fidelity, all these big brokerage houses have a function, but where the line is blurred is where you think you're getting advice but you're really not, because they're not a
Mm.
fiduciary. And then you're getting a bad product or there's a bad outcome because of that.
And then we have, certain political elements happening where we see political leaders doing really well in the market. And, the suggestion is that they're getting some inside information and they're performing better than, Warren Buffett and things. It's so confusing to the consumer out there as to who to trust.
Yeah.
It's very, very troubling. And that's why somebody like yourself, when you just kind of clearly explain what the differences are and how you're paid and how you're not handling the money and how, these kinds of things have to be clearly stated and clearly pursued by the consumer.
Yeah, you do. I mean, the federal government is trying to do a better job. There's some new regulations that have come out that put more pressure on brokers for more disclosure, and to try to like clearly distinguish when advice is being given and conflicts. But it just is, the problem is the brokerage industry is really in bed with the regulators. A lot of regulators are former high level executives at these brokerage firms, so it's just not really to the level that it should be. And so as a consumer, you just really need to educate yourself. And I try to spread the word about fee only financial planners. I encourage other you know professionals like myself that are not fee only financial planners to consider going in that direction, because
Mm.
I just think it's really the future of the business and really how we can make this a profession, really, with a standard of care.
And your podcast does a great job. You've got excellent content, Ryan. You do a lot of homework. You're informing us. You do a really good job at that. One of the ones I want to kind of talk about, we mentioned before we got on, was your predictions of 23. These are always fun, and you're not professing to go in this direction. You're just clearly stating as a prediction. Your first one was the S&P 500. It declined almost 20% last year, but you're predicting big growth this year.
Yeah, I just looking at the past, S&P, like over the last like 100 years roughly, that generally when you have these really big declines, usually you have a really big comeback the following year,
Mm.
just because things tend to normalize. So I had put a big number out there. I think I put 28% was my
You did.
prediction, which
You
people might
did.
think I'm crazy. But I mean, I think I calculated like 24 or 5% would just get us back to where we were at the beginning of 2021. And then I just predicted like it would close slightly above there, like a 3 or 4% increase above that.
And by the way, we're talking in early February of 23 right now, and these are the predictions for the year. But the only thing you could do is base it on history, like you did, and just make a prediction that way.
That's right. Yeah. I mean, when I never put this formally out there, but I've had predictions in my mind. Figured, okay, time to hold myself
Good for
accountable.
you.
Let's see
Good for
how
you.
I do this year. So
Very cool. And the second was growth stocks, so that they've outperformed that of the 12 years, like 120% gain. But you're predicting growth.
I am. I just think again, like the pendulum swung so far the other way. We look at some of these big companies like Tesla, for example, was down like 66% last year.
Right.
Apple, I forget what the percentage was, but it was down very close to that. So we've already started to see that at the beginning of the year. Like Tesla's off to a good start, and Apple, and so that's what I think will happen for this year.
Are we in a recession?
Well, technically, a recession is 2 negative quarters of GDP growth. So we've been
Right.
in a recession for a while, but I think like people want to when they really think recession, we think about past recessions, which is like large layoffs, right? Like maybe housing market correction, sometimes stock market correction, but the stock market usually bottoms out well before we start to see those other negative things happening because
Hmm.
the stock market's a leading indicator. So, we've already probably seen a lot of the bad, most likely in a lot of these companies. So that if things start to turn good, it could happen even like when we're in the midst of the recession that profits start to come the other way.
Yeah, like you said, the definition is 2 quarters of negative growth, and we've had that. And I've heard they try to redefine what a recession is to soften it. It's so silly, but that's just the case. But you're saying we're seeing a lot of layoffs now, but it seems to me that's just a correction of over hiring.
Yeah, it probably is. I mean, things went crazy, after COVID with a lot of the technology companies, and they did a lot of hiring, and the job market was very good as a, employee because they were paying you a lot and they were very flexible with a lot of things. And I think some of that is starting to lessen because companies have a little more leverage because there's going to be less job opportunities potentially.
And we still see unemployment. It was just released like under 4%, right? And
Yeah.
didn't the U.S. added 600,000 jobs or something like
Yeah,
that last
it
month?
was a lot more. They predicted like 200,000 and they added, like you said, almost 600,000. So um, we're not we're not seeing it. I don't know what it's going to take. I mean, the Federal Reserve, like they have a couple tools to try to cool an economy, and one is raising interest rates, and that's what they
Right.
did last year. Massive raises, as far as like the largest in like almost 40 years, and it still didn't really do a lot yet. I mean, it hasn't maybe fully been seen, but maybe that's a good sign for the U.S. economy. It's pretty resilient right now.
Your next prediction, number three, is on large cap, increase about 70%. But you're predicting the small cap to outperform large.
That's right. Yeah. Just think that again, small cap had really kind of sold off a little bit and has much more room to run, for the next year.
And what's the difference between large cap and small cap?
It's based on the valuation of the company. So they have something called a market capitalization, which is like a company's value. Very simply, you take the stock price times the number of shares that a company has, and that gives you a number. And small cap companies are usually 2 billion or less. Large cap are 10 billion or more.
Oh, I see.
And I mean, we talk about really large companies. There's companies worth over $1 trillion. I think like Apple was the first one years ago to hit that
Yeah.
level. So 10 billion is really nothing, as far as valuation of some of these massive companies. But when you look at these small companies, you think about more like a regional company, maybe, or they're in a really small area or only have a really niche product. If they have success within that area, they can see their stock price double or triple, and that's why they offer a lot of growth but also a lot of volatility because they could have like a bad an issue with the product they have, and all of a sudden like sales drop by 50%. That would really
Hmm.
hurt the company.
And then we have Meta, and perhaps you can, it was Facebook, who actually bought shares back and increased their value. And then Wall Street loved it and stock prices went up. How does that work, Ryan?
So yeah, I mean these big companies that start building up large cash reserves, they have to figure out what to do with this. And
Huh.
one option is to buy back their stock because let's just say make up a number, they had 1 million shares of stock outstanding and they were earning $2 a share and all of a sudden they bought back 100,000 shares so they have 900,000. Their earnings per share is going to go up because
Mm.
there's less shares. So that's why they do it. I mean, companies are always issuing new shares because through like incentives, like stock options. So they have to really be buying back shares to some extent, or they're always going to be issuing more, and that just further dilutes the earnings for like the existing shareholders.
Yeah, you always hear about that, about delusion there. But then you have Elon Musk, who actually sold billions to fund other projects that he
Yeah,
was having.
yeah. I don't know like his balance sheet of what he's been buying a lot of stuff. He bought Twitter. So maybe
Yeah.
he just had to sell off some shares. I mean, it wasn't a great time because, like I mentioned earlier, Tesla had been down so much. Would have been better to do that like last year, beginning of the year, or the year before when it was at all time highs. But it's hard to know that.
And then we saw price cuts of Tesla and their vehicles, but it looks like they're increased again. It's just these, I mean, there's just really smart people making these decisions, and hopefully they're correct. I don't understand why, but
As far as
how
the
can
price
we?
cuts in Tesla,
Yeah, and just the overall decisions like that.
yeah, I think from what I read, there was an article in Barron's that due to like I forget the new bill that passed through Congress was a Secure Act like 2.0.
Oh
There was
yeah,
something in there that had to do with like the tax incentives for buying electric cars. And up until like March, no matter how
that's
many
right.
cars have been sold by the company, because previously, once a company sold 200,000 units, the tax credit went away. But they would get the tax credit provided that based on the size of the car, whether it's a sedan or SUV, it was under a certain price. So I think Tesla to meet that, they had to cut the price. So
Of
that's one
course.
reason they did it. I don't know if they're going to, once we get past March and that incentive goes away, if they're going to raise the price up again. But I know you hear both sides of the coin. It stinks if you just bought a Tesla like the month before
Right.
and you paid 10,000 more and now you could buy it, the next day and it's 10,000 less. That's just unfortunately the way their pricing works.
I mean, the answer to all these questions is just always money, right?
Sure.
It's just,
Yeah.
I mean, that's follow the money.
All the money. Yeah. Yeah.
Yeah. So your fourth prediction is Bitcoin. You have a very, Bitcoin versus gold. You're predicting gold over Bitcoin. Bitcoin suffered a lot last year, but just
Yeah.
your whole viewpoint on cryptocurrency is
Yeah. I mean, I'm not, I'm definitely a late stage adopter in most technologies. So maybe I'm not the best person to ask. But there's so many ways that clients can make money without buying crypto that I don't really encourage it. It's very speculative. There's a lot of fraud that goes on there, especially with some of these other coins.
yeah.
And it's just very volatile as well. I mean, you can see like 10% moves in one day. And we can see big moves in the stock market, but I think only a few times, like in the 1987 sell off, did we see like 10% moves. So I just think that a lot of the people I deal with, retirees, are probably should stay away from that. But,
Just because of the volatility.
just because of volatility. And it's just I think more maybe down the road, there'll be better technology to track it and maybe the volatility will lessen. I could be wrong here, but that's just my philosophy on it.
I mean, we see what's happening with FTX, of course. That I mean, I mean, he had a stadium in Miami. We're talking
Yeah,
about
right.
billions of dollars,
Yeah.
and now he's in jail. He ran off to Bahamas, and it's just it's just very scary.
Yeah, I mean, we always, it's like we always see these bubbles and they come and go. And I mean, we had the .com bubble, then maybe we had the housing bubble,
Hmm.
and now we've got the crypto bubble that burst
Hmm.
last year. And it's terrible if you had a lot of money tied up in it. I mean, you also could have made a lot of money, but if you had to get out before everything started to blow up, essentially. I mean, I forget, like Bitcoin, how much it was down last year. It was like 60 something percent, I think.
Yeah,
But
yeah,
yeah, I looked back over like the historical returns. I mean, it made a lot of its money early on. And then, recent years, it hasn't been as good as like in the first couple of years, but back then nobody even knew what it was. I mean, nobody owned it when it was like
right.
$10 a coin, you know?
When you hear, financial giants in your industry like Warren Buffett say, I'm not going to touch any of that. Does that influence you at all?
It's hard not to listen to Warren Buffett,
Yeah,
but I mean, people could argue, oh, Warren Buffett, I don't know how old he is, like 90 years old, like
right.
he's old school, and I guess you could say I'm somewhat old school too. But I just look at what's happened with it, and just the stock market and, small cap stocks, if you want to get aggressive, offer a lot of volatility potential that's much more regulated. You're less likely to have fraud. So that would be my philosophy, to just avoid it. But if you were going to buy one, I definitely think Bitcoin or Ethereum, because they're really the two biggest, would be
Mm.
probably the safest of any of them to buy. Because I'll see on Facebook like somebody promoting some random coin. I mean, that's just, first of all, it's probably illegal. Secondly, do you really trust your college buddy or high school buddy who's telling you, "Oh, buy this coin"? Like, he's obviously trying to pump up the price to probably sell his coins after you buy it, or a lot of people buy it. So it's the pump and dump scheme all over again.
Again, it's just these things that just cause so much concern with the consumers. Talking about Warren Buffett, I remember somebody asked him about, we see these blurbs that asked him about economists, and he's like, I know a lot of economists. I like economists, but I don't know any really rich economists.
Yeah, that's true. I mean, maybe. I mean, there could be a few, but
Yeah. So your kind of core tenets, Ryan, like what your philosophy, you promote diversity, asset allocation, and staying in the market. Those are very cool cores. Talk to me about those.
yeah. So I'm definitely not a market timer. I mean, I'm not trying to like time, okay, I make predictions about the market, but like I'm not trying to make a buy or sell decision off that prediction. So talk about Warren Buffett. Why is he so rich? Because he's been invested in the stock market for like 70 years.
Long
He's
term.
never sold.
Right.
And he always looks at it as when things are down, it's a buying opportunity.
Mm.
So I mean, most academic research supports that. Diversification, definitely. I mean, we talked about individual stocks. Most research says like if you're going to own individual stocks, you should probably own at least like 20 to 30, because that way, if one company blows up, if you had FTX, let's say, as one of your stocks and now it's worth zero, then that didn't ruin your portfolio. You still had other quality names in there.
Mm.
And then another core tenant, which you didn't mention, really be like low cost investing.
Mm.
So I also really, for a lot of people, they probably shouldn't pick their own stocks. It's just very hard to do. Warren Buffett would even tell you, like, when he dies, like his portfolio is going to go into an index fund, which is just, tracking the overall market. So for a lot of people, they're probably better off buying an index fund and focusing on one that's low cost, because that allows the investor to keep more of their money rather than paying like high, annual management fees.
Very, very interesting. Let's talk about Wall Street perception versus reality.
Sure.
When you know, is it a bad idea to invest in companies that you personally believe in? Like, I have a Costco addiction, for example. I'll just throw
Yeah.
those out. I can't, I just love it in there. I don't know if it's the high beam ceilings or what it is in there. I just
Free,
love it.
free samples.
Yeah, the samples are great. I still enjoy Disney with my kids. They're over 20. We love it more than ever. Some couple of things like that, but they're not the best stocks to invest in.
Well, you raise a good point. So, I mean, I think you have to have, first of all, a philosophy or some overall strategy of what you're doing. If you're just randomly buying things here or there, that might not be the best. So
Mm.
getting back to what I was saying about buying individual stocks, if that's a small percentage of your portfolio, that's fine. But if that's your majority of your strategy, I would say trying to follow those principles I mentioned of having probably 20 to 30 stocks, and then also having diversification across the different sectors. So there's, I think, like 11 different sectors in the S&P 500. So having like exposure to all of those. Because that way,
Hmm.
like if you're just on like, let's say the consumer discretionary, like Costco or Disney, or you're just on like technology, you're going to see some really big swings from year to year. And it might be years before that sector is really doing the best. So I think it's better to invest across all of them.
Yeah, diversity. It's so important. Your number five in your prediction is domestic versus foreign, and you lean towards U.S. market doing outperforming.
Yeah, I just think that the US consumer is a little stronger than the European consumer. We started to see like a little bit, US stocks have really led foreign stocks for a number of years. And we started to see a little bit of a bounce in the foreign stocks coming up end of last year into this year. But I still think the US is going to have another good year. They're just still struggling with issues with Russia and Ukraine and, getting energy delivered with the good prices and also getting the energy. So I just worry about that impacting Europe this coming year.
Yeah, the geopolitical ramifications on on spending is so. What's happening over there is just horrible, and we all hope it comes to an end.
Me
One of
too.
your yeah, one of your podcasts is great. You talk about, you have kind of seven credit rules where credit is really overlooked by a lot of
Yeah.
people, and your score, and you want to pay off credit early, automatic payments, and get fees waived. You do a really good job of trying to negotiate your APR, but managing credit cards and managing debt is just a huge burden on specifically the American population.
For sure, and it starts early. I don't think I mentioned that in that podcast, but I remember maybe you have similar experience when you were at college. Like
Oh
you'd
yeah,
be walking through campus and there'd be like a table and they'd be giving away T-shirts, right? Or,
right.
or like a $10 gift card to Domino's, and
That's right.
get this credit card and you can have free pizza tonight. And so a lot of people did, and I resisted that for a long time, and then I did, and then I found myself using the card. I think I might have done it my senior year, and then like all of a sudden I've got like $1,000 credit card bill. I'm like, whoa, I can't even pay that. So yeah, you've got to really build the right building blocks early on, and um, you know, live within your means. It's not always fun to do, but we all have to do it, or else we're gonna be paying really high interest on these credit cards, which is horrible.
Yeah, absolutely. And you talk about just is it important to get regularly check your credit score? I mean, that's a really important score on a lot of things that you do. You have to buy a car, you have to buy a house, etc.
I think it is. Yeah. I mean, it's a little easier now because there's like um, credit karmas, like you can do that and get your
Mm,
score. You could also go the route of like each credit agency, the major three, you can get your free score once per year at no cost. So if you go like directly to Experian, TransUnion, or Equifax, you can get your whole score and your full report. So that's
yeah.
also important too, to see like what credit you have, make sure it shows that it's being paid on time if you're paying it on time, and also what inquiries have come across for your credit, because that also impacts your score a little bit too.
And also, I've checked it, and there's been things that have been paid off years ago that were still on there. So I had to dispute it, and
Sure.
these kinds of issues too that are just hurting you when they shouldn't be. Somebody didn't do a good job of removing it, and that's really important as well. Another podcast you talk about the Secure Act. You kind of alluded to it earlier,
Yeah.
2.0 that Congress just passed, and how it affects us.
Sure. Yeah, I mean, probably one of the big ones is that for older people, it used to be at 72, you had to start taking money out of your retirement accounts. It's called required minimum distributions. Well, that changed to 73 this year. So if you're turning
Hmm.
72, you got this year, you got one more year you can wait. And then it'll go, I think in 2035, it goes to 75. So like for you and me, we now get to wait till 75 until we have to start taking money out of our retirement accounts. Yeah.
Wow.
Yeah.
Wow. It'll be here before you know it. Yeah,
Yeah.
Congress does these things, and you hear about them in the news, don't really understand what they mean, and we have somebody like yourself, committing yourself to to explaining it to us. You did a really good job there. Another great podcast you had is where I was just flabbergasted, lowering your electric bills. You talk about strategies
Yeah.
of what you could do there. I mean, you do such a good job at presenting this stuff, Ryan.
Thank you. Yeah, I mean, and yeah, and just, the podcast is Retire with Ryan.
Yeah,
You can find it on any major podcast
all
app or go
platforms.
to retirewithryan.com. But yeah, the electric bill, I mean, we're seeing that one in Connecticut because, so in Connecticut, there's two components to your electric bill. There's the generation charge, which is what your utility company charges you for the electricity. And then there's a supply charge. And you have the ability as a consumer to pick a different supplier, because sometimes a supplier can have a lower rate. So if you go to energizect.com, every state, if other states offer this, I'm not sure if they do, they might have their own website. But why I'm mentioning this is that the supplier rate just doubled on January 1. It went from 12 cents to 24 cents. So
Wow.
that's a major increase in your bill because that's about half of the cost of your bill. So one thing you could do is you could maybe switch to another supplier. That's what I was able to do. You'd have to check at what the current rates are. I think I got like 14 cents or 13 and a half. So I only saw a modest increase in the cost of that. So that's one thing you could definitely do. I talked about like smart thermostats.
Yeah.
I have those like wireless. That way I can make sure somebody didn't leave the heat on full blast and, and go out for the day. So
Yeah, absolutely. I'm a big technologist, and I'm away for the winters there, and it was particularly cold, and so I'm able to control my, in case pipes don't burst, I can control them from where I am, away from the home. Just the smart technology really, really helps. And speaking of technology, you had another podcast where you just talked about, trying not to get hacked and to avoid that. One of the biggest things you say is get a password manager. You mentioned that I happen to use Dashlane. I don't get any money from them, but just having that helps tremendously.
yeah, that's really important. If you don't want to commit to that, making sure you have two-factor authentication turned on to as many of your accounts as possible. Because without that, if somebody gains access to your account, usually they'll gain access to your email first. So it's best probably to maybe make the two-factor authentication your cell phone. You'll get a text message because it's unlikely someone would steal your cell phone and your email. It could happen, but that will prevent it. I use Facebook sometimes, and for Facebook advertising, and I had an account I hadn't used in like 6 months, and all of a sudden I started getting charges,
Huh.
and somebody had actually not hacked my email; they hacked my assistant, who had access to my Facebook Business Manager, and then they went in there and they removed me and her as administrators, put themselves on, and
Wow.
started putting all these ads. They were actually in another language. I think they're in Arabic, but I guess they violated Facebook's advertising policy. So they shut it down, but I'm still dealing with Facebook. They haven't fully rectified the problem. This was about 3 weeks ago. So if I didn't have, that was one account, I didn't have two-factor authentication. And I thought I did, but I didn't. So if I'd had that, it would have probably prevented any of this from happening.
And we see 2FA, two-factor authentication, even when you go to get gas, you put the credit card in and it asks for the zip code, right? So it's getting
Yes.
multiple factors of, authenticating. And 3 or 4 months ago, my girlfriend called. She said, my Netflix is all in German for some reason. It has shows that I don't. I said, did you use the same password there that you use in other places? The account's been hacked. You have to call Netflix and get it back. So somebody sold your password, and somebody in Germany has taken it over. Just using different passwords, using real passwords. Password manager really is the best way
That
to
is
tackle that.
because a lot of us will probably use like a password you can maybe remember, but those are
That's
probably
right.
easier to hack. So if it's got like multiple numbers and characters in there, it's not going to be hacked as easily.
Absolutely. I don't know
Yeah.
any of my passwords. It's all saved there. And
Yeah,
and the manager has two-factor authentication. So,
that's right.
so it's protected as well. People say, well, that's even worse that I have everything in one place. What if they hack that? But I have never heard of a case where 2FA or multi-factor authentication has been broken. So your last prediction, number 6, was on interest rates. We talked about that earlier. So you see two kind of minor increases happening this year, and it's going to end at 5.25.
That was my prediction, yeah, for the federal funds rate. I mean, the Federal Reserve just had their meeting like last week, and that's what they did. They raised a quarter point. Their next meeting, I forget if it's the end of February or March, but I thought maybe like another 0.5% increase, and then we'd kind of level off at that number. Um,
Yeah, we've had it so low for so long, and I thought somebody said that over the 30-year average, like the average has been 6 or something. We're actually been still below. Is that true?
It could be, yeah. I haven't seen that number in a while. I mean, I know historically, we hadn't seen rates be that low. I mean, they were low like after the 2008, 2009 correction, and then
Mm,
they got up pretty good, and you were getting a decent rate. You can see this like on your short-term savings, money market, CDs. You could get like a CD paying you like 3%, 4%, and then after COVID, they cut rates again to zero. So, and they just took too long. Most people would agree, like they took too long to raise rates up again. Everything really overheated. Between that and all the stimulus money, we had all this inflation and they were behind the curve. So I hope they leave rates here for a little while, maybe like a year to, 18 months, just to let things kind of normalize. Because as a saver, you really like when rates are up because now you can get a competitive rate of
mm,
interest at the bank or on your money market accounts. As a borrower, it stinks because now you're not going to get those 3% 30-year mortgages anymore. But
right.
that really has not ever been the norm.
Well, I mean, as far as mortgage, what do they say? Marry the property and date the loan, or something like that. Or
I've never heard that. I like that.
yeah, yeah. So you could change. Yeah, you could certainly dip in and out of that. So on the podcast, Ryan, we talk about discipline. I lost a lot of weight. We talked
Yeah.
about it before, and people always ask me, how'd you lose the weight? And like they want some secret way. They want the easy way. Uh, and I just say discipline. I got focused. The doctor said, you're not going to see your daughter graduate. You have two beautiful young kids
Oh, thank
yourself.
you.
And uh, I just say discipline. That's it. I got focus. I got discipline. How does discipline play a role in your life, Ryan?
Sure. If we talk about like business wise, I mean, you got to get up every day and show up for your job for sure. So I
Mm,
mean, I've been doing this for like 20, what am I in the 21st year here of doing this?
wow.
So I've been clocking in, not always every day. I take some days off here and there,
Of
but
course.
every day, almost every day. And with the podcast, I mean, I decided like 2.5 years ago, I'd wanted to do a podcast for a while. And when COVID happened, I teach adult education classes. That's one way I get the word out about what I do.
I didn't know that.
And so I had a couple scheduled that obviously there was no in-person meetings anymore after COVID hit. So they got canceled. And I was like, well, I think it's a good time now to finally do the podcast because I wanted to keep getting the word out. I didn't know how long we were going to be unable to meet. And so I started the podcast and I committed to doing one every week. And I will say that's hard sometimes.
Yeah.
And because like you said, most of my shows are solo shows. I got to do some research, write some content. So what's helped me is really time blocking, definitely, and so I block out usually every Tuesday, like half the day that I'm going to do my podcast, and so that helps me to stay disciplined, time blocking, and other aspects of my life and business too.
Yeah, and you a couple of I saw you interviewed this woman about college, tuition, and you do interview as well, but you do a really good job on that, and keeping committed to that is important. And when consumers want to choose, somebody to handle their wealth like this, there's got to be a certain discipline that you must require by them. I mean, I'm sure some of them, hey, this Bitcoin, I want to put all my money there, or I heard of a hot stock that does this. I mean, certainly, I would think that you have to say, well, remember, we need to diversify. So you have to does this happen at all?
Oh, for sure. Yeah. I mean, so I have 6 different strategies I offer to clients. And so my clients have to commit, first of all, to one of those
Ah,
strategies so that if they want to buy Bitcoin, if they want to buy stock or trade their own portfolio, they can do that on their own. It's so easy now. We talked about online brokers, right? They don't really need me to do that. But if they, for the majority of their money, they want me to manage it and use the disciplined process that I've been using for almost 20 years, then that's what I'm here to do. But
hmm,
a lot of my job too is really, the hardest part I would say is managing people's behaviors, because money
hmm,
is emotional, right? I mean, it means different things to different people. And when people start seeing like their money go down, especially, they can really question what we're doing, and they'll
right.
want to do the wrong thing, which is usually selling
Panic.
out of their portfolio. And it's usually at the
Mm.
bottom of the market. So a lot of my time when things get bad is really I become more of a psychiatrist or psychotherapist to really try to help people do the wrong thing. And I'll use different facts and things, but it comes down to emotional decision. And so that's, I think it's hard, but you kind of have to separate yourself and not be emotional about your money when, managing it, but also when hiring a financial advisor. You really have to go beyond like, oh, I like he or she, right? They seem like a nice person. Well, Bernie Madoff was a nice person too, right?
Yeah.
And you got to really do the research and make sure that you're getting the right person that's looking out for you, and also, not trying to harm you at the same time.
So have you gotten a midnight phone call saying my stock is it's crashing? What are we going to do? And you have to give them the discipline conversation. Ride this out. It's long term. It's diversification.
Well, I used to give people my cell phone, but I stopped doing that years ago
Uh,
because I get too many texts and calls. But I will get emails. I've gotten some emails. I'm asleep, but I wake up. I see I got an email at 3 in the morning. We got to talk. What are we gonna do? But if I do my job right, and that's really educating the client about what the possible outcomes are beforehand, so we can go back and look at the different models. And why I have these models, it's based on the risk level. So younger clients want to be more aggressive. They're going to see more growth, but also more swings in the portfolio. That's just the nature of, if you try to achieve more growth. People that are more conservative, not so much, volatility, but less return. So I try to educate them, okay, like here's the worst case we'd probably expect, so that they're not surprised to see, oh, I went down 10%, but that's very normal for the portfolio you have. That's happened many times before, and despite that, we've still had a very good return over the long term, that type of thing.
mm. Brian Morrissey, what motivates you?
So I would say what motivates me at this point is my family, definitely my children. Um, you know, as I've built my business, I'm very fortunate. I've built a successful business. I help a lot of folks, and I've been lucky to be able to do that. And so that was really what motivated me for a while. And at this point, it's really my children, making sure that I'm gonna, do what I can to spend as much time with them as possible, and also take care of myself, like you mentioned, so that I'm gonna be here health wise as long as I can.
Mm. It's amazing how children just refocus you and
They do,
change
yeah.
your
I had no
change
idea.
your. Right. Yeah.
I had children late in life, so I didn't realize what I was missing, but I'm glad I didn't miss it.
Yeah, and it continues. It gets better. I mentioned my daughters are in their 20s, and yeah, it's just I adore them and love spending time with them more now than ever. How do you measure success, Ryan?
That's a great question. I mean, um, I set some goals for myself usually the beginning of the year. So,
Mm,
I look back to see if I've achieved those goals. I mean, that's probably the best way. And then I look at industry numbers as far as, other successful advisors, like what are they doing for their clients, certain things they're delivering. So I want to make sure that I'm delivering value to my clients, so I measure it that way too, making sure that I'm really making an impact on their lives and, helping them in the best way that I can.
That's noble because you're in the trust business, Ryan, right? People,
Right.
because the market is the market, the economy is the economy, but people have to trust you. You do your research. You're going to be there in good times and bad, and measuring success along with your clients, your friends is, I think, the best thing to do. Absolute pleasure talking with you today, Ryan. I really enjoyed it. I know we pushed this off a couple times, but it was
Yeah,
well worth
likewise,
the
Joe.
wait.
Yeah.
So how can we get in touch with you?
So probably the best way is to go to retirewithryan.com. And I have another website for my business. But if you go to there, you can find out what you need to either listen to the podcast. I have blog posts. I've recorded some Facebook videos, YouTube videos I'm in the process of posting. Or you can also, if you think I'm a fit for you, you can request, an introductory phone call to see if it makes sense to work together.
And we'll put that in the show notes. Retire with Ryan. Your content is excellent. You're cranking along. 134 episodes. You're going really well. Thank you for your time, Ryan. And I look forward to seeing you on the course in the spring.
That's right. We'll get some golf in. Yeah.
You be
Thanks a lot,
well.
Joe.
Bye.
All right.
Bye
Take care.
now.
Bye.
Thank you for listening and or viewing Joey Pinz Discipline Conversations. Please share this episode with one or two of your friends who you think may benefit from the episode. Our website, www.joeypins.com. There you'll find lots of resources and you could join our mailing list. Please follow us on all our social media, Instagram, Twitter, and Facebook. Podcast information, the video version of our podcast is on YouTube. Please subscribe. Audio is on all major podcasting platforms. Please follow them. And if you like it, please consider giving 5-star rating. Would really appreciate that. Would you like to financially support the podcast? You can go to our Patreon site. Consider $5, $10, or $20 a month. There's all kind of plans that we have there. There's like a one-time payment. What is this podcast episode worth to you? $25, $50, $100, $500, $1,000, $5,000. You be the judge. You can go to our PayPal account to do that as well. Thank you again for listening or watching Joey Pinz Discipline Conversations.